On April 4th, retail investors smashed the buy button on the S&P harder than on Christmas Day 2020 when Belle Delphine IPO'd her OnlyFans. But what the fuck happens when retail investors buy the dip, but at the same time, Warren Buffett and other institutions turn into a retail investor and panic sell? And why is that happening? You're watching Macromind, and I intend to answer those questions. Usually retail investors panic sell whenever the S&P falls more than a couple of percentage points, which results in a wealth transfer from dumb money into smart money. But whilst retail investors were busy buying US stocks, major financial institutions were hedging against the US dollar, selling US treasuries, reducing leveraged loan portfolio exposure, and selling US stocks. The modern retail investor has poorly translated investment knowledge from finfluencers, who have poorly translated investment knowledge from US media outlets, who have poorly translated investment knowledge from real investors like Warren Buffett. They've learned to buy low, sell high, and believe that the market always recovers. So a retail investor's understanding of a discount is the price of the S&P today versus yesterday. This is a very superficial view of what value means in company valuation. Valuing an index is not the same as buying Red Dead 2 when it's 75% off on Steam, because Red Dead 2's already been made and won't have any fundamental changes in the future. To determine whether the S&P 500 is actually at a discount today versus yesterday, we need to do some extremely complicated math known to the scholars as division of how much profit the S&P 500's companies produce relative to the price of the index. This is known as the forward price to earnings ratio, and simply put, the bigger this number is, the more expensive it is to buy the S&P 500 relative to the amount of profit it's generating. At today's level, we are above the historical average, but at a lower level than most of the post-pandemic era, which on the surface suggests that it's a good deal. But it isn't, because the future estimated earnings per share of the S&P 500 and the analyst forecast that this data comes from has not yet truly reflected the risk of tariffs and economic uncertainty in the US, and the earnings estimate has actually increased since the end of March. If you cut the earnings forecast for US companies to reflect tariffs, your PE ratio shoots upwards in line with the really high 5-year average. In other words, there's no discount or sale on US companies today. Investing influencers and Trump's insider tweets might tell you not to worry about this and that US equities have no risk because the markets always recover, so you should continue to dollar cost average into US stocks. This is a lie, and it's why institutional investors are behaving differently. We only have 68 years of S&P 500 data and 141 years of Dow Jones data. That's not a long enough time frame to assert that markets always recover, and it's partly why when you go on a trading platform, there's always a disclaimer saying past performance is not an indicator of future performance. We shouldn't ignore history because there might be some useful information there, but that information is only useful if the current environment reflects the environment we had in the past, which in this case it doesn't. Since the early 1900s, the US has been the world superpower, and that hasn't been called into question yet. So, whether it was the dot-com bubble, the 2008 financial crisis, or the pandemic, there was always a high degree of confidence of the US dollar being the world's global currency, the US Treasury being solvent and a risk-free safe haven for money, as well as the US having dominance in trade relations and geopolitics globally. Now that that confidence has been threatened and there's a real risk of China upstaging the US as the world's superpower, it means we can no longer use historical examples to assert that there will be always a full market recovery. Historically, the real risk of investing in the S&P 500 and the difference between institutional and retail investors was exit timing, which is determined by an investor's time horizon. This means for younger retail investors, it was less risky to invest than it would be for a financial institution who usually have short to medium term investment time horizons, which is determined by the company's investment mandate. They don't have the flexibility of waiting 40 years to see if the market recovers, so they have to diversify their portfolio into bonds. However, today the situation is more extreme. Not only do financial institutions understand that US stocks are not trading at a discount relative to historical averages, they realize future index performance is fundamentally driven by improvement in US company earnings, and those earnings are hard to forecast because they're a combination of current macroeconomic conditions, the momentum of geopolitics, domestic legislation, and other environmental factors, which at the moment has strong negative signals coming from the US. There's no magic force growth mechanism driving a country's index upwards, regardless of what finance influencers want you to believe. If that were the case, then major economies like Italy, Japan, and Greece would have all recovered from their respective market crashes given enough time. The retail investor not understanding these principles brings us towards some scary potential futures. Because of the overwhelming belief in US superiority, retail investors are overexposed to the US stock market both in terms of their portfolio allocation and livelihood. They maintain an average ratio of $5.4 invested in the US market for every $1 in international stock. If you're an American citizen investing in American stocks, you're double dipping your risk exposure because you're exposed to poor stock market performance and exposed to potential firing, wage cuts, or job stagnation. If the US enters into a period of stagnation over the next few years, similar to the period of 2000 to 2012, and the US dollar weakens, Americans will see losses in real terms due to rising inflation, which means no more trips to Paris, London, or Bali. I spend hundreds of dollars a month on economics and financial data subscriptions in order to bring you guys quality informed videos. Surely that's worth you subscribing for.